Hey everybody, it's Mike over at Taxes and Bricks. Well, welcome to episode 45. It's another mailbag, so get your letter openers ready because we're going to be opening up some interesting questions. Today we're going to talk a little bit about my accounting origin story. Someone asked me a question about how I became a big nerdy tax guy. Also going to be talking a little bit about estimated tax payments, not so much what they are, because I think we've gone through that before and most people know, but we're going to talk a little bit about if your tax guy tells you you should make them, are you supposed to make them? What happens if you don't? And then a couple more questions. One about bad debt. What happens when you loan somebody money and they don't pay you back from a tax perspective? So again, all the names and sort of facts of these have been changed and altered enough to protect the innocent. Also because it's a tax topic today, we're going to be throwing up a little disclaimer. So hang in there for that and we'll be right back.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, thanks for hanging in there for that disclosure. So first question actually came in from a client I've known for a while, but I guess we've never really talked about this. He asked me how I got to be a tax accountant. So here's your answer. After college, I had studied criminal justice and law enforcement in college. I actually went to work for the State Department, the United States Department of State, working for a company that served on their law enforcement and security contract for diplomatic security. Nothing to do with accounting, of course. I actually liked the job. It was, it was fun, but it was definitely interesting. It was right inside my wheelhouse in terms of my level of education and the sort of experiences I had when I learned in college. But after a couple of years, the job seemed a little bit boring to me. It wasn't challenging. And in the interim, because I was young and, in my early 20s, I took a job working the front desk at a friend's mom's tax accounting firm and just, administrative stuff, collating returns, learning about the tax forms, things like that. I mean, I knew about taxes and I knew how to prepare taxes and I knew a bit about accounting ahead of that. Nothing sort of formal in the sense that I, went to school to study to be an accountant. But got a lot of experience on the ground experience for a number of years, sort of working both places. And it kind of occurred to me when a lot of my fellow officers at the State Department found out I was working at an accounting firm to, kind of help them out a little bit, answer some questions, provide some clarity and some truth in some of the, for lack of a better term, bull that they had been fed by their accountants or by other people. My brother's cousin's uncle's father's sister told me, I'm allowed to write off my parking tickets. And I'm thinking to myself, I know that that's not true. So I kind of thought maybe this was a thing. I should do this. I should help people out a little bit, my fellow officers. And so I did, and help them with their taxes around tax time. And between that and the accounting firm and everything, and then I got a few other clients, it sort of just kind of snowballed. Eventually I had enough work where the State Department job kind of became a bit more of a distraction to me. And also I looked at the accounting side and said to me that there was more of a future and I was enjoying it more. So I started my own private practice and the rest is history. I developed and built a client list and a client base, and I've been working and serving my clients now for, got to be going on 20 years, or actually more than 20 years now. That's how I got started. I really do like helping people with taxes. I think that there's a lot of bad information out there. There's a lot of good information out there. And so I think dispelling the bad information and then helping my clients locate and take advantage of the good information has been the highlight of my career. And so that's how I got started in accounting, and I do love it. I hope one day maybe my kids will come in here so that dad can retire and they'll take over and find a love for accounting like I did. And, there you have it. So the next question came in from another client. First time I had given them the recommendation to make estimated tax payments to the IRS. If you don't know what an estimated tax payment is, basically if your returns are showing a deficit, if we look at maybe a projection early on in the course of a year and we think, hey, listen, there's a good chance you're going to owe some money when we file your returns a year from now, then I will often make a recommendation to a client, whether they're an employee of a company and they have tax withholding, or whether they're a small business owner, self-employed corporation, something like that. I'll say to the client, listen, I think that you really need to pay in advance, because if for no other reason then it helps you avoid a giant balance due when we file your taxes, the government can actually penalize you for owing too much money when you sit down and file your taxes annually. So to avoid that, to avoid the discomfort of having a bajillion-dollar tax bill, I make the recommendation often to clients to go ahead and pay their estimated tax payments throughout the course of the year. The question really more was the client wanted to decide whether or not they could just adjust their withholding at work instead of making the estimated payments. And the answer to that question is, of course, absolutely, you can do that. The government doesn't care where it comes from. They just want the money. So you can ignore the estimated payments. And that's exactly what I told the client. Go ahead and just ignore the vouchers. And then he said to me, well, but wait a minute. You prepared them. Isn't the government going to be expecting them? And I kind of chuckled a little bit, which is a good question. And it's a valid question. The answer is no. I'm not going to wipe them out, okay? They're not filed. At least I don't file them with the government when I send your tax returns in. And I don't know any accountant that sends them in advance to the government and says, hey, by the way, I sat down and told this client he should pay these, so here they are. You should come knocking on his door when he doesn't send you a check every 3 months. That's not what happens. These are recommendations. I tell clients all the time, and I told this same client, those are between you and me, okay? My recommendations to you. You can choose to ignore them and figure out another way to pay your taxes, but the government doesn't know about those vouchers unless and until they're spying on you. No, unless and until they are received with payment, okay? So if your accountant gives you these vouchers and you don't want to pay them, understand you do that at your own peril if you're not going to figure out a way to get the government the money that your accountant thinks you're going to owe. But you don't need to actually worry that they're there and they exist in the ether and you're not sending them in. So I don't wipe them out and send a client a whole new version of the tax return or anything like that. It doesn't work. The only time I will ever do something like that is if I send the estimated payments to somebody and they go, well, you sent me estimated payments for $3,000 a quarter, but we think that we're going to owe $20,000 a quarter. Okay, fine. Pull them back. We'll give you new vouchers and go from there. But if you get an estimated tax voucher from an accountant, number one, don't just ignore it. Talk to the accountant before you ignore it, okay? I mean, I have clients who say, oh, well, I saw those, but I didn't know what they were. I didn't think to pay them. And I said, well, it's funny because you owe, $15,000 and I gave you $15,000 worth of vouchers a year ago. Mystery solved as to why you owe money. But anyway, so that's the thing with estimated payments. They don't get filed in advance with the government. And if the government doesn't know about them until you actually put stamp to envelope, send them away with a check, or go online and pay them with the government. So second to last question of the day. I actually think that we talked a little bit about this in a prior mailbag, but I got the question again, and so I figure we'll throw it out there and see what comes up of it. A client wrote to me and indicated that during the course of 2021, they had a rental property and their tenant did not pay for a couple of months of rent, and then the tenant left, okay, and as a result, the tenant said, well, I can't pay you, so I'm going to move out. So I guess that's kind of menschy of the tenant, and the property sat vacant for a couple of months while my client figured out what to do to get another tenant in there. And so the client said that they understood they can't write off the rent that the tenant that was there before didn't pay them, and that's correct. You can't. If the tenant owes you $1,500 and didn't pay you, you don't get to then put a subtraction of $1,500 on your tax return. But the next question was whether or not, and I think this is where we differ from the last example that I gave a couple of mailbags ago, during the time period where the property isn't being rented, is the taxpayer, in this case my client, able to take what they would have charged for rent that they didn't collect from nobody and then write it off? And the answer to that question is no as well. You cannot deduct money you don't collect. It's just not tax accounting wise possible. It just doesn't sort of work in sort of the study and science of taxation. What you can do in a case like this, whether you've got a tenant in there who's not paying you, or you're in between tenants for a short period of time, you may continue to consider the property in service for rental and therefore continue to write off all of the operating costs and carrying costs to keep the property running, such as utilities, mortgage interest, the insurance you pay, condo fees or HOA fees if you're part of an association, property taxes, supplies, repairs, painting, maintenance, you name it, all of the things, the advertising costs to get a new tenant in there, commissions you might pay to a real estate agent or a broker or some kind of a, rental finder, organization or company, something like that. So while you can't take a direct subtraction for the rent that somebody didn't pay you, which we've been over before, and you can't take a subtraction on the returns for rent that you would have collected but didn't because the property was vacant, you are permitted the operating costs. If you think about it logically, let's say, you have a store, okay, and your store is full of, products, and you have, the store open on a Friday and nobody comes in to buy anything, you can still take the expenses that it took to keep your store open on that Friday. But you don't get to say, well, I should have sold $1,800 worth of stuff today and I didn't, so I'm just going to subtract $1,800 from my tax return. If you think about it in those senses, and then you substitute in the example of a rental property, it's basically the same situation. So no to deducting rent you don't collect from a tenant, which we've been over before, and no to deducting rent that you would have been charging but weren't collecting because there wasn't a tenant in the property. All right, so last question came in from a client who loaned a friend some money, a few $1,000s a couple of years ago, and was not able to collect from the friend. And my client indicated that really there was no promissory note, there was no written agreement, the person was just kind of falling under hard times, and my client kind of came to the rescue and gave him a couple of bucks to bail him out, and never really expected this person to pay them back. And I said, well, unfortunately then, what you gave him really wasn't a loan, it was a gift. And as a result, there's nothing we can really do about that. But it brings up sort of a point that that's not always the situation. And you may find yourself in the situation where you actually have given somebody a loan, a bona fide loan, whether it's a friend or family member, whether it is, through a business transaction. Say you are a real estate agent and you've got a client who, needs to make some significant repairs to their property in order to get it to sell. And so you either make the repairs yourself with the understanding in writing that they're going to pay you back, or you give them the money and then they're going to pay you back after the property sells and you don't get your money for some reason, one reason or another, then you do in that case have a bad debt. If you have a bona fide loan that you set up with a friend or family member, say, somebody comes to you, I'm going to say it's a child, they want to buy a house, and so you're going to loan them, $250,000, or you're going to loan them $100,000 or something like that. I think the key takeaway here for me is that in general, when it's a related party situation, between family members certainly, but amongst friends, there's always a level of skepticism that there's a legitimate loan situation. I mean, if it's between you and Bank of America, I mean, that's pretty clear cut. Bank of America, they might love you, but they don't love you enough to just give you a gift. So there's going to be sort of an inherent relationship that's just there and believable in terms of it being a real loan between a bank or a financial institution and you, the consumer. However, when we're talking about two parties related to one another, either by friendship or by family, there's a level of skepticism. And so when a client comes to me, and this happens quite a bit, and talks to me about loans with respect to either them getting or receiving them, my first piece of advice is get something in writing. Get a contemporaneous document with a date on it and signatures and an agreement and all of the things that you would normally have. Call it a promissory note if you want, or some kind of a loan agreement or a lending document. That's the first step to formalizing this, such that in the end, there could be, if you don't get paid, a little tax pot of gold at the end of the rainbow for yourself. The second thing you want to make sure you're doing is actually charging interest and trying to collect in the same way, sort of, that a bank or a financial institution might collect, where you have sort of a monthly payment schedule or a quarterly payment schedule. There's an annual payment that's made, something akin to what you would have with a bank if you were getting a loan. I think that those two things, having a written agreement and having, you know, sort of set terms, makes the loan look valid, such that in the end, if you're not repaid, there is something that you can do tax-wise to deal with it. In general, there are two kinds of bad debt, we'll call it that. There's business bad debt and non-business bad debt. We went through a quick example of business bad debt. You're a real estate agent, you give some money for repairs, somebody doesn't pay you back. In the event that the money that you lent them had already been somewhere on a tax return, you know, it was out of savings, or maybe it was out of your business account or something like that, then you would simply deduct that from your gross income on your business tax return, be it Schedule C or your 1120, 1120S, your 1065, whatever you file for your business. If it's a personal situation, okay, we talked about it in the sort of the prior example, you can't deduct money you've never received. So things like, you know, you let somebody live in a piece of property and they don't pay you rent. That's not a bad debt situation. But let's say you went ahead and lent your tenant money. You know, they're your friend too, or it's a family member and you lent them money or whatever. That's a personal, non-business bad debt. So long as there's something in writing, so long as you've made attempts to collect, you don't need to go to court and get a judgment against this person. But the year that the debt is considered uncollectible anymore, you've done everything you can. You either come to some kind of a written or verbal agreement with the individual that they're just not paying you back. You can show that the person ghosted you, I guess, and say, you know, it happens. You know, somebody owes you money and all of a sudden you never hear from them again. That year that occurs, that is when the debt becomes deductible. But it's not a dollar for dollar deduction on your tax return per se. It's a short-term capital loss, okay? And thus, if you have capital gains on your returns, you could offset capital gains from investments or other types of sales and things like that. If you have no capital gains to offset, then you'll be allowed up to $3,000 of a subtraction on your tax return for that year. And then anything remaining will just carry forward until you either use it all up with the $3,000 per year, or you have gains to offset. So that's kind of how it works. I will say this, if it's a related party, just be careful. Make sure you have your ducks in a row, because most of the time these related party situations, they just look like gifts. And also, on the gift side of things, if it's enough money, it could trigger gift tax issues. So you want to be careful there. So that's it for the bad debt. That's also it for today's mailbag. Thank you for watching. Hope you enjoyed it. I'll be back Monday. I'm really trying to pull together this age episode because I think it's really kind of interesting. There's a lot of things that happen at various ages, starting from birth all the way up until not birth, death. So, and sort of, it's not just you're born, you turn 21, you get to legally drink, and then you collect Social Security, and that's it. There are so many different benchmark ages in between that will have good implications and bad implications tax-wise for you and for your parents and other dependents and things like that. So stay tuned Monday. Thanks for watching. Have a great weekend. Don't forget to like, subscribe to our channel. Like I said, we're up above 100 now, so it'd be great if we could get up to 200 or 500 or 1,000. Remember, 1,000, I still get a GoPro camera. Somebody's going to buy me a GoPro camera if I hit 1,000. So at this rate, I don't know. Could be. Never know. Maybe you can help. Thanks for watching. Have a great day.